Hi, this is Tron Welch with Welch Financial Planning, and we're going to go through the Q1 2023 quarterly investment update. Talk a little bit about how the market did in 2022, and then talk about what we're looking for in the future and how we're positioning portfolios moving forward. So to no one's surprise, I think everybody understands the market went down 19-20% in 2022. Very, pretty volatile year and just kind of a difficult year to be an equity investor. The one thing that is of interest is that the bond market was also down about 11% for the year. So for the traditional investor, there was very few places to hide, and so everybody's accounts are basically down. For long-term clients, you know that we do not use bonds in our portfolios. We are using alternative investments in that sleeve, and we did better than the 11% down, but we certainly captured the loss of the equity market. So, what we did see is a 19% down by the end of the year. It was down 25% at one point. Quick review of what this slide is. It's called the measles chart. The solid line is where the market ended up at the end of the year. And the red dot, or the measle, is where the market was down at the furthest point through the year. So you can see basically every year there is a down year, and then the solid lines, going back from 1980 to 2022, there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 down years out of that time period. So it doesn't really concern me when the market goes down. It's just kind of the normal cycle of it. And this year was no exception. The reasons it's down are pretty obvious with the high inflation, supply chain issues, obviously Russia going into Ukraine, a lot of disruption in the marketplace, and corporations have a little bit of trouble hitting their margins and estimates. So, but at this point, this is the PE chart, and this is kind of, it is a macro measurement of where the market is. And basically PE, which is price divided by earnings. So how much are we willing to pay a price in stock for the earnings that they have? And so what this is telling us, when the PE ratio is at 22, for every $1 of earnings the stock has, we're willing to pay $22 for that stock. So you can see, time periods where the PE ratio gets a little bit on the high side, and it's typically followed by down markets on that. But where we are today is the PE ratio at about 16-17% is right on the 25-year average. So where we stand today, it's fair to say that the market is reasonably valued, and we should see some growth moving forward. So if we look at corporate earnings, which is on the left side of this display, you can see that we've got, starting in the estimates going on in 23 and 24, kind of a little bit of down going on in the earlier parts of 22, and then picking up in the later parts of 23 and then in 24. So I think we've got a couple more quarters of just some general malaise, and then corporate America will kind of get his feet back under it, and away we go again. So profit margins, this kind of is the last of the three slides here to show that S&P margins did decline quite a bit in 2022. So as their costs through inflation were increasing, some companies were able to pass those through, and some weren't. And so the corporations that were not able to send price increases through because we just won't buy it at a higher price. And you can think of like gasoline. Gasoline's demand doesn't really change as the price does. It does a little bit. For the most part, we'll pay whatever they're asking for up to some certain limits. But if you think of maybe some luxury goods where let's take fine dining is probably a good question on that, where you'll pay X for it, but if their prices go up 20, 30, 40%, you're gonna stay home and not pay that. And the restaurants are then gonna have to kind of lower their margins or keep their prices steady while their costs are increasing and damaging margins there. So nothing really surprising in any of those charts. It kind of tells the story that we already know. This chart is a little bit busy, but I think it's worthwhile to go through, and it kind of tells us where we're headed to. So on the right side, the current PE versus the 20-year average PE. And this is the large cap. So these are the big companies, and you know every single name that's in this category. And basically, we're kind of making the argument these are largely fairly valued. There's not a lot of opportunity out there in terms of picking up some benefit as the economy grows. But if we go down here to the small cap, we can see that the small cap, the current PE ratio, is all below its 20-year average, and significantly below on the small cap growth. And we can see the chart below that small cap growth is actually only trading at 70% of its value. And so we see some opportunity there. And moving forward, you'll see your accounts being reallocated into some smaller firms. And we hope to, capture some value there as the stock market investors come back. So the other big story that is impacting investing right now is the strength of the dollar. And we can see that the dollar really shot up starting in 2020, obviously through COVID, up to and became really expensive in later part of 22, and then dropped back down a little bit in 22, but still way above the average, going back to the 2000s. And the term strengthen of the dollar, I think, is a little bit confusing because that's viewed as a positive thing. And really strengthening the dollar or weakening the dollar, the pros and cons of that depend on where you sit. So when the dollar strengthens, that means that when we take our domestically produced goods and try and sell them overseas, the strength of the dollar causes those goods to be more expensive when we try and sell them to Europe or Mexico or Canada for that matter. And so a strong dollar really makes it difficult for exports. Now, if you are a traveler, the strong dollar, you love the strong dollar because then when you go out to Europe or Canada or something like that, the strong dollar makes all of their goods seem inexpensive, and you're able to travel with lower cost. So right now the dollar is very strong, and we do anticipate that the dollar will weaken moving forward as our interest rates kind of normalize and come back down after inflation is in place. So we do see some opportunities that we want to be in the international markets. When the dollar weakens, we'll get some tailwind on that and get some help on the returns by the dollar weakening. You can also see in like the U.S. trade balance here on the right-hand side where, the trade balance from 2019 up to kind of a peak in 2021, that's all the strength of the dollar. And that's making our goods expensive when we export them, but it also makes the imports or things that we buy from China less expensive, and makes our economy really difficult to compete. So the weak dollar would help us quite a bit economically, but also everybody in the world is looking for a weak dollar to strengthen their economy. So it's not just a flip the switch or a policy change that will cause that to happen. But then the big slide that I want to talk about today is the international valuations and a little bit of dividend yields. And the way that you can look at this, and most of it's on the right hand, the left-hand side, sorry, that I want to talk about, is that this is the amount of discount that we are paying for international stocks, meaning that we are now 2 standard deviations away, or 3, when we buy an international company, we're buying it at a 30% discount than historical averages. So between the dollar being really strong right now and the international investor has just kind of disappeared, there are some great opportunities in international. It's kind of one of these interesting stories. I've been receiving emails, probably 2 or 3 a day over the last 4 years that international, and they basically have been generally wrong for the last 4 years. But we feel at this time, with the recent shift in the interest rates in a post-COVID environment, that the opportunities in international, we believe, are real at this time. And so we will be reallocating portfolios from some of the larger domestic stocks that we've traditionally held for a long time and sliding more to that to international. We feel like there's more to gain with similar risk profile than what we've seen right now. So we did a pretty good job of keeping this short and just kind of hitting the big highlights. But to kind of recapture a couple items, I feel like the stock market is fairly valued today. If we do go into recession, which we may or may not, and if we do, it will probably be light. I don't see a whole lot of repricing there. So a 20% down from here would be really surprising. A 10% down from here would be really surprising. Now, that being said, a 10% up would not surprise me, but a 20% up really would. So I think we're looking for some modest but positive gains for 2023. And then we need to reposition the portfolios to find better investing opportunities. And that's going to be international, kind of away from the large cap US based stocks, moving more towards smaller US based stocks and moving to the international side. So if you have any questions over this or just want to continue this conversation a little bit more depth, feel free to give me a call. I love talking about investing strategies and how I'm able to help my clients achieve their financial goals. So have a great day, and we'll talk to you soon. Bye-bye.